In quarter three, the economy continued to run hot with rising long-term interest rates, the key concern in financial markets. Hi, I'm Paul Delaney, a wealth advisor at Capital Insurance Group. I'm going to discuss some of our observations about key indicators in the capital markets as we move into the fourth quarter of 2023. Let's look at how the key areas of the stock and bond markets did in Q3. In the equity market, we had a good July, as we expected, followed by a weak August and September. The net effect was that all the key equity indices were down between about 3 to 5%. Likewise, bonds were negative across the board except for very short-term paper like Treasury bills. Basically, the longer the maturity of a bond, the greater the loss suffered in the quarter. If we look at our equity indices in terms of percentage off their most recent highs, you can see that we have yet to recoup the declines of 2022. Small cap US stocks and emerging markets have seen the largest declines. Turning to bonds, we see percentages off the most recent highs or even worse. The core US bond aggregate ETF, called the AGG, which is the most common proxy for the overall US bond market, shows a drawdown from the most recent high around COVID of nearly 16%. And long-term Treasury bonds, the blue line here, are down a staggering 45%. So to say that it's been a tough environment for pretty much all assets is an understatement. As Warren Buffett said, interest rates are to asset prices like gravity is to the apple. They power everything in the economic universe. All of this is consistent with the late phase of the cycle, which we show as quadrant 3 in our investment matrix. This is where we have continued economic expansion but with tightening financial conditions. The drivers of financial conditions are bond spreads, equity prices, treasury bond yields, and the overall exchange rate of the US dollar. The latter two of these components, increasing treasury bond yields and the appreciating dollar, have recently been driving tighter financial conditions. When financial conditions tighten, asset prices, all else equal, tend to come under downward pressure, while loosening financial conditions tend to boost asset prices. We can see that depicted in this chart, which shows the forward price to earnings ratio on the S&P 500 inverted and plotted against the Goldman Sachs Financial Conditions Index. You'll notice that as financial conditions tighten, shown as the black line going up, the PE line also goes up, which is the P ratio declining. Now let's focus on interest rates for a minute. We all know that long-term rates have gone up since COVID from near zero levels, but it's been the speed at which they've increased that has pressured asset prices. You'll see from my crudely drawn lines on this chart that recent interest rate increases have already taken us back to roughly the average rates that prevailed prior to the Great Recession of 2008 to 2009. The purple horizontal line with 5.35% drawn on top of it is the average 10-year Treasury yield for 1994 through 2007, which is about 50 basis points higher than where the 10-year yield ended September at 4.81%. The orange line with 4.23% drawn above it shows the average federal funds rate for the same period. At today's 5.5%, we're about 125 basis points higher than the recent pre-Great Recession averages. The reason why the period before the Great Recession is an appropriate baseline is that between 2008 and 2017, the Fed undertook quantitative easing, or in everyday terminology, printing money, and then it did it again during the COVID pandemic and aftermath. And if we zoom back out to 1790, as Deutsche Bank does in this chart, the 10-year Treasury yield is now about in line with the average over that entire period. There are various drivers of the increase. On the demand side, the big buyers of Treasury securities have largely left the market. They include China, Japan, US banks, and the Federal Reserve. While on the supply side, the level of Treasury bond issuance is enormous, and it's being driven by both the short average life of US Treasury securities and by the gigantic budget deficit the federal government is running. We normally expect the federal budget balance to reach its nadir during recessions. Recessions are shown as the vertical grey lines here. And then we expect the budget balance to reach its maximum at the top of the economic cycle. Well, we're at the top of the economic cycle right now, but the current balance is negative 5.34% of GDP. It's more negative than almost all recessions going back to World War II. That's a cause for real concern and may drag the Fed back into the questionable practice of buying bonds again. Now, we've been cognizant that some asset classes have been more at risk than others from tightening financial conditions. We exited REITs in March of this year. And China too. A bursting property bubble adds to demographic collapse and geopolitical risk as key concerns there. In July, we exited the last of our long-term bond holdings. August saw us exit gold positions as now high real interest rates make this non-yielding asset less attractive, for the time being at least. And finally, in September, we exited US small cap stocks. All of those changes have helped to protect portfolios during a difficult period where central banks globally are turning the screws on asset prices to tamp down inflation. This doesn't mean there's a lack of investment opportunity. For now, large US stocks look decent. While they're no bargain at 19 times estimated earnings for the S&P 500, if you strip out the Magnificent 7 large US tech stocks, the PE drops a few notches to acceptable levels. Earnings estimates are also pointing to some growth over the next 12 months. That's the blue upward sloping line on this chart. And while we shouldn't take those earnings estimates as gospel, Wall Street tends to be optimistic, we do see the outlook modestly supported by a recovering manufacturing ISM index, which is the orange line here. With large cap US stocks, we also have the seasonality of S&P 500 returns working in our favour, which are on average most favourable in the fourth quarter, as you can see here. Should seasonality prove to be a false beacon, short-term bonds are a great alternative where we can get paid 5 to 6% yields while we wait for better times elsewhere. And so to sum up, rising interest rates and a rising US dollar are putting most asset classes under price pressure, many the most at risk we exited months ago. The economy is still growing, and for now at least, large US company earnings are expected to keep growing. We'll stay invested in risk assets that still present a positive risk-reward trade-off while avoiding those that don't. And as always, we remain nimble as the data comes in. Thanks for watching. We'll see you in the next video.